This is Mark from Right Line Trading, and what I'd like to do is to go over an indicator that we created here at Right Line that's really unique and something that you've really never seen before. And I want to start just with the with this disclaimer. It's mandatory disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational and demonstration purposes only. Right Line takes no responsibility for any participation by visitors or subscribers within the futures, forex, or stock markets, nor for any profits or losses that may be incurred. We all know that trading is risky and that you can lose a substantial amount of money, and that trading is not appropriate for everyone. You should always consider your financial position before you trade. Do your own due diligence. And Right Line Trading is not a registered financial advisor and is not a licensed commodity trading advisor. Now, what I want to talk about is the oscillator, and take you from the Stone Age of oscillators up to what we've done here, and that is create the most unique and I think the most powerful oscillator analysis that you may have ever seen, and one that I think is really important to trade with. One of the things in which there's a real significant paucity of information, even on YouTube if you look, is about oscillators, how to leverage them and how to trade them. Now, everybody has their own idea about, I think, how to trade an oscillator. I'm going to give you my take on it, and I'm going to explain to you how I've come to those conclusions. Just a little bit of background about the oscillator itself. It was created by George Lane in 1957. Now, I really want to go fairly quickly. I'm not going to do much background on George Lane, but he was a real genius and a mathematician. And in 1957, there was no sophisticated charting programs, even rudimentary charting programs whatsoever. But he postulated that as a rule, the momentum or the speed of the rate of change of stock price changes before there's a change in price. Now, I'm going to explain that in a lot way, in this way. Momentum is a second order derivation. And what it tells you is if a stock is moving up, it tells you if momentum is positive, it's telling you that it's accelerating faster and faster to the upside. So the speed of the move up is increasing as the move goes up. And if the speed continues to increase as the move rises, then momentum is going to increase. If the speed of the move of the rise of a financial instrument is constant, then momentum is flat. And he believed, since this was a second order derivation, that changes in momentum foreshadowed changes in price. So what he did was he looked primarily for divergence signals. And that's the only way he used the stochastic oscillator that he created. He looked for changes in momentum, which preceded a change in price, and he looked to fade the market. And that's the only way that he used to trade the oscillator. Now, this is the oscillator formula. And I wanted to show it to you to really acquaint you with exactly what you're looking at. Now, this is the stochastic oscillator, the RSI, there's Williams K, there's a whole bunch of them. But they are all basically variations of this basic formula. And what this basic formula tells us is that C is the recent closing price of the stock, future, or forex market. L14 is the moving average, the 14 previous lows. H14 is the moving average of the 14 previous highs. And as the close of the candle approaches that moving average of the highs on a long trade, momentum is increasing. As the close continues to approach that moving average of the lows, then momentum is increasing. Now, if the price doesn't continue to move closer to the low, the price of the stock or Forex or futures market can continue to fall, but momentum is not increasing. And that's how the percent K line is created. It's simply an assessment of momentum, or the fact that price continues to increase in acceleration upwards or increase in acceleration downwards. And percent D is simply a 3-period moving average of percent K. Just that simple. We're talking about a change in acceleration to the upside, a change in acceleration to the downside, and you can juxtapose acceleration with velocity. We want velocity to be ever increasing, like a race car driver going around the track. If he's going from 60 to 70 to 80 to 90 miles an hour, his momentum is increasing. But if he's staying at 180 miles an hour, he may lead the pack, but his momentum is not increasing. So I hope it's clear what we're talking about. Now, this is what George Lane looked to do. When price made a higher high, but his oscillator made a lower high, what he was saying was that here, price accelerated up with greater, it increased in price, the increase in speed of price was much greater here than the increase in speed of price here. So that momentum was lower here than it was here. And that this decrease in momentum would precede a drop in the price of the stock. And here's just one of my slides. The price is making a higher high. Stochastic is not making a higher high. It's making an equal high. So we know that from the rate of change of velocity of the move up here was equal to the rate of change of velocity here, but price moved up higher here. And this is going to herald a drop in price on divergence. Now, here's a divergence failure. You get stochastic making a lower high, price making a higher high. So we know that momentum on this move up is diminished. And we get a little bit of a drop, but then price really comes right back up. And here's the problem in trading divergence signals today. And that is, and let me just show you this one other slide, because it shows how the oscillator was meant to work and how in a perfect market it would work. And probably back in 1957, this really closely approximate how the oscillator actually worked. And that is when the oscillator line or percent K line crossed above the 20 line, you got a long trade. When it dropped below, right here again, crossed above the 20 line or the oversold line, crossed out of it, got another long signal. When it crossed below the 80 line, which is overbought, you got a short signal. Again, crossing below the 80 line to the downside, short. Crossing above the 20 line, long. Crossing below the 80 line, short. And the majority of these trades were very successful. And this is on Facebook. And I just took this off the internet as a way to show you how the oscillator was meant to work in a perfect market. I think if you actively trade the market, you know that it very rarely does this anymore. And I've seen many YouTube videos where traders talk about the two best indicators to use, which are a combination of MACD and oscillator analysis. I'm going to show you now why the entire paradigm via which we need to trade an oscillator has completely changed. Now, here's what happens more often than not, and that is as stochastic creates overbought signals, the market just continues to rise. So you can go overbought and stay overbought, and price will just shrug it off and just continue to move up. And why does that happen? Now, and why does this not herald a move to the downside? So every oscillator move off the 80 line to the downside didn't take price down very much. This uptrend remained intact with very little retracement, even though the oscillator fell all the way. And these were all oscillator failures, with price continuing to remain in an uptrend. Now that's what we anticipate to happen today. And I'm going to tell you the reason why. Because back when oscillators were first developed, there was really very little institutional volume in the market. It was basically a market comprised of commercial traders, like you and I. There was no computer-generated trading and no big volume. And today that is no longer true. Now, if the market is only driven by small commercial traders, then essentially what we're looking at is a market in which the power of each seller is equal to the power of each buyer. No single entity dominates the market. Now, even if somebody trades a 100 lot or a 50 lot, they're outliers. And for the most part, buying power and selling power is equal among each individual trader. And when that was present, oscillator divergence was a very good signal. But that is no longer present and is actually going to be something that, as we move out into the future, is going to actually become less and less common. Right now, depending upon the market you're trading, institutional volume now dominates and determines the direction of price. You know, if you look at crude oil and you look at gold, as much as 75% or more of total volume in a given day is created by the institutional traders. Now, they have an enormous amount of power simply compared to the commercial buyers and the commercial sellers. So it's now no longer true that an overbought market can be faded with divergence and traded short, or an oversold market traded with divergence and traded long. Because a top is determined by institutional volume and a bottom determined by institutional volume. And I'm going to show you, I made some trading rules of how you need to trade an oscillator in today's market. And if you don't trade it this way, now, you and I, all of the traders know that sometimes divergence works, but oftentimes it fails. And you can't use a signal that fails sometimes and works other times, and you can't make an assessment of risk on the trade. So you simply have to eliminate divergent signals, or you're going to get beaten up. And the rules that I've created are this. As far as the oscillator is concerned, there is no such thing as overbought or oversold. This is a fallacy. Markets reverse direction only at the whim of institutional money only. Now, every financial instrument still wants to revert to the mean. I mean, that's a mathematical axiom, is that price always wants to pull back. I mean, your mean can be the point of control. It could be a 50-period moving average. Whatever it is, whatever that mean price is you're looking at, price wants to pull back to that. But it's not going to pull back to the mean until the institutional traders have stepped aside. Now, if the institutional traders pull the price way above mean, it's going to probably snap back harder once they step aside. The problem is you don't know when that's going to happen, and you can never be sure when that's going to happen. So until they step aside, you're not going to get reversion to the mean, and overbought or oversold really don't have any statistical validity with regard to the oscillator. So trading a divergence signal is tantamount to trading against the direction of money flow or institutional money. And we can only trade in the direction of institutional money, which is the direction of money flow. So we have to change the way we use an oscillator if we want to get 80% or more of our trades as winners. And so far this week in the live trading room, I'm trading right at 78%, really close to 80% winners. That's what we need to do. Now, we have to format an oscillator or an oscillator variation that completely ignores divergence and simply is going to track the flow of institutional money. It's accurately going to assess buying and selling pressure, again, completely ignoring potential divergence signals. That's what's going to help you. So what we've looked at is the Laguerre. Now, the Laguerre is the most sophisticated oscillator created. It's got a gamma factor. When you modify the gamma factor, it changes the speed of the Laguerre line or the oscillator line. It's got multiple filters to calculate the final value that Laguerre line is going to trace out. So you want a Laguerre line that has speed but has stability. Now that's hard to do, but that's what we've optimized here. We've changed the gamma factor and changed the filters to create a Laguerre that really works well. Now I'm simply going to show you our single time frame Laguerre and show you how it works. And then you're going to get an idea of how our multi-time frame Laguerre works. Now just ignore this yellow line for a second. It's part of the Laguerre analysis, and it's called fractal energy. And I left it up there, but it really doesn't have very much validity. And it's supposed to measure volatility. So if that yellow line rises into a move, it's supposed to tell you that that move has the potential to go a long way. It really is not very accurate. I don't use it, but I've just not chosen to make it transparent. The line that we're interested in is this cyan line right here. Now, every time that the oscillator crosses above the 20 line, we get an arrow. That's part of the software, and you're going to get this arrow. This arrow is going to print intra-candle, so you have plenty of time to place your trade. Now, there's only a few other rules I want to acquaint you with. You can only trade above the 50, you only trade long. Below the 50, you can only trade short. That's market structure. And we believe that when price is above the 50, the bulls are in control. When price is below the 50, the bears are in control. So on this Laguerre arrow, you've got a long entry. And then what happens is the Laguerre crosses the 80 line and stays locked long Now, 35 years ago, actually almost 40 years ago, traders would look for divergence to fade the market. What we know now is that this is a marker of institutional money flow. And when the Laguerre rises to the 100 line and stays locked long, this is when price is going to rise because it's tracking the flow of institutional money. Now you can exit this trade on a down Laguerre arrow, or you can exit the trade on a break of support. If you exit on a break of support, you don't exit to all the way over here. But you never counter trend trade or fade the market. And every time you get a Laguerre locked long signal, you know that price is going to rise. Now, if you leverage this up arrow or this signal right, this cross above, and stay long on the trade, this is a 30-minute of the Qs. You got a tremendously great trade. Now, this is a 60-minute of the Qs. Here's your short Laguerre. It crosses the 80 line to the downside. You get the arrow on your chart. I just didn't put it there. You're going to get it intra-candle. If the candle closes down, it's going to print. You're going to have your sell stop order already in place. Then the momentum moves to the downside all the way. Then Laguerre locks short. And once it locks short, it's telling you that institutional money is pressing this market to the downside. And you just watch price fall. And if you trade against the direction of this Laguerre, you're really going to get beaten up. You have to stay short when institutional money has the Laguerre's back pressed to the wall to the short side. Here's just another oscillator out, perfect trade. You're above the 50 and the 15. Long trade, lock long, ride it up. You can exit on this arrow, exit on this arrow, and exit on a break of support, or exit on your automatic trade management strategy, depending on what price targets you're looking for on a daily chart of the Qs. This is a daily chart, so this is a very, very big move. And this is one thing that I want to clarify right up front, and that is that it does not make any difference what instrument you trade, and it does not make any difference what time frame you trade. Momentum is a universal force that moves price on any financial instrument. I know there'll be questions about, does it work on Forex? Does it work on stocks? Does it work on futures? Does it work on different time frames? If an indicator does not work on any time frame and work on every single financial market, telling you it's harnessed a universal price, a universal force that moves price, then there's something wrong with it. So it does not make any difference what you use to trade this with. Here's a move down, arrow short, then you get your lock, and down you go. You can exit on the up candle. There's your short arrow below the 50, the lock short, you can exit on the up arrow. We never take counter trend trades. A long trade below the 50 is considered an exit signal. We don't trade this instrument long. And here I wanted to compare with you quickly, and then I want to spend a lot of time on a live chart showing you the multi-time frame assessment. Hang on one second, let me just click that out. Showing you how the multi-time frame Laguerre works. This is just the one time frame Laguerre. Looking at the price on your trading chart. You get the arrow down. Now, this is stochastic, and here's the Laguerre. The Laguerre locks down, and it's telling you, again, institutional money is pushing this to the downside. Now, who are these traders that are going long? that are trying to call a bottom and trying to take a counter trend trade. They're traders trading oscillator divergence and MACD divergence on other time frames. Maybe they're trading off of Fibonacci support. In any event, they're going to lose because you have to trade in the direction of the flow of institutional money. Now, the Laguerre keeps you in the trade through the whole move. You can see the line, it never rises above the 20 line. So that lockdown red stays present. The oscillator, stochastic oscillator, takes you right out on these two up candles. Gets you in here, 2 candles early, blows you right out. That's why the Laguerre, in the manner that we've made it smoother and more stable, even though we have not slowed it down, allows you to hang into a trade. And once momentum wanes, you're going to get an exit signal very fast. It's not going to keep you in this trade long. It's just a better assessment of momentum. Now here is relative strength. And I'll show you the difference. Here's RSI divergence. You've got divergence making a lower high, and here price making a higher high. Now, in the old days, you would take a short trade, but now we know that we're above the 50 and above the 15, and we're looking for the market to lock long, which it does right here, and we take our long trade. Then we get the oscillator signal, our Laguerre signal long here, and we take another long trade. So the only thing that relative strength does is to give us one divergence signal that fails and no long entries. That's the difference between our modified Laguerre, RSI, and stochastic. I had one that compared Williams K2, also is going to bounce you out of the trade very fast. Here's Williams K, and again, bounce right out, right here, on these 2 down candles. The Laguerre makes a slight move off the 100 line, never falls below the 80 line, and you're locked long here all the way. Your exit is here, and you've got this huge move. This is on crude. It's a fairly recent move, and it's a monster move in the direction of the footprint of institutional money. I'm gonna just blow through these slides. This is just other trades of the Qs daily. Here's a faster time frame Q. I don't want to waste time on this. Let me go over to the multi-time frame assessment. And let me drop the slides. Now here we go. Now, what you do is you get a more valid trade if you use the Laguerre on a multi-time frame basis. Now, I am missing one thing here that I need to put in. Let me find my Laguerre here. Just hang on 1 second. 1 second. right, there we are. I'm sorry. Now, there are two other indicators that come with the package, and I had forgotten to add them. This is our 50 EMA of a 50 EMA. We use the EMA formula twice, and we use this in order to provide this 50 with the speed of an EMA, but the smoothness of an SMA. And this is a 15 EMA of a 15 EMA. Put through the formula we use, you get the speed of a 15 EMA and the stability of an SMA. So I just wanted to add that. These are two indicators you're going to get. Now, I just want to make sure that my Laguerre longer term is set correctly. It is. Now, what we're going to do is look for the long-term Laguerre, or here's the multi-time frame assessment of momentum. Here, here, and here. It's not being used off the trading chart. It's looking at two higher time frames. No matter what you're trading, it'll always be looking at two higher time frames. And what you want to do is take the Laguerre on your trading chart and trade it into the higher time frame. So let's take an entry right here. Let me give you a classical entry. Obviously, it's going to be, here's an entry. There's the arrow created by the cross of the Laguerre down across the 80 line. And look at the multi-time frame assessment of momentum. This is the Laguerre on two higher time frames. Down you go for a really nice short trade. So you're trading in the direction of the multi-time frame alignment of momentum. Now, I don't recommend you take counter trend trades, but if you were a counter trend trader, here's the cross of the Laguerre on your trading chart into a multi-time frame aligned momentum to the upside. And up you go. Now, I think you should only take trend trades, and those are the only trades I'm going to show, are short below the 50 and long above the 50. Here's another trade. Actually, this trade does not work. The multi-time frame is not aligned. Now, here's your trade. You know what? That multi-time frame is not there. Now, here's the other entry you can take, and it's any pullback to support where you've got the Laguerre locked long and the multi-time frame assessment long. So you note with this up arrow, that Laguerre momentum on your trading chart is up. You know from the multi-time frame assessment line that momentum is also moving up on your higher time frames. When you get this retracement, you're in right here. And this is a terrific long trade. Same thing here. Green, green, and up. I'm off the edge. And let me increase the number of days we look back, and I'll show you a whole bunch of other instruments too. Right now we're only looking back 4 days. And because I really want to give you a feel for how to trade this. Let me go to 10 days. Still loading. Okay. Now, let me find the perfect trade setup. Now there are lots of entries here. This pullback, I think I already showed you. This short trade with the multi-time frame Laguerre red. This short trade with the multi-time frame Laguerre red. It's a small trade. This short trade with the multi-time frame Laguerre red. So all you want to do is take a trade when momentum is down on multiple time frames. The arrow tells you it's heading down on your chart. The line or the bar here tells you it's also heading down on your two higher time frames. So what you're doing is a triple screen assessment of momentum. And when you trade in the direction of that triple screen direction, it's going to be very difficult to find a losing trade. Now here's another one right here. Short. Now the thing about these trades are they're exceedingly low risk. Right there. Now right here, I mean, sometimes you have to do an assessment on a pullback. This isn't your classical entry with an arrow, but I want you to get a little bit of a feel. Now the first 10 traders who purchase the indicator are going to come into the room with me, and you're going to get a month in the training room. So you're going to really see, it's going to get really kind of nailed down how we utilize it. But when we get a pullback and then a continuation trade short, all we need to do is look at the long-term assessment of momentum, which is red, right here, and look at the Laguerre on our trading chart, which is locked short. And we know we've got 3 time frames aligned to the downside, and the likelihood of this being a losing trade extremely low. Let's look at this long trade here and this long trade here. Now, I'll show you, this is a loser, I think. Actually, this comes with the long-term time frame assessment yellow. So it censors your loser. You can't take that trade. This comes with your long-term time frame assessment green. I just want you to see the crosshair. It's green here on this entry. It is yellow. On this entry, the oscillator, the Laguerre on our time frame is locked long. The multi-time frame assessment is up, and up you go. Now this kind of move is just unbelievable. I mean, you've got this trade as a handy. The multi-time frame momentum is short, and your oscillator on your trading chart is locked short. So down you go. Down you go. Right here, down you go. Whoops. On a downsloping Laguerre line. So all we're looking to do is take either entries that are placed on our chart intra-candle by the indicator, and if the candle prints, the arrow prints, nothing ever repaints. This is an easy way of doing the assessment of the Laguerre on your trading chart. If you don't get a down arrow and you get a pullback to resistance on a short, you have to check the slope of the Laguerre. If it's sloping down and your multi-time frame assessment is red, you're into the short side. They're both valid signals short. And just so happens in this particular case, almost everything is short, but that's just the way it is. Now, let me show you another instrument. Let me go quickly here to, I'll go to the E-mini. Now it's loading. And I have to change the inputs. This is a Unorenco chart, although you can use any formation you want. For us, we use a 248 Unorenco setting on the E-mini. Let's give the multi-time frame assessment a chance to find itself. Now, let me reload the chart. I only got 2 more minutes, so I don't want to run over. And I want to get to your offer, and I want to get to your questions. So I got 2 minutes to do that. So let this turn over. I'm going to do this really quick. But again, it does not make any difference the kind of candle you trade. You are harnessing a multi-time frame assessment of momentum. It's the direction that you want to trade in. Now, while this is loading, let me show you the offer. Now, if you counter trend trade against a triple lineup of momentum, you're going to have a big problem. And this is where you're going to get stopped out a lot. Now, I'm just going to show you the offer. Unfortunately, I don't have time to wait for that to load, but trust me, it works on any financial instrument. Now, the Laguerre, it works on stocks, futures, or Forex. Now, normally it's $5.99, but because we're on Trader's Corner, we're going to give it to you for $2.99. You get a lifetime license, and we give you 2 licenses if you want to go on 2 computers. Anytime we make it better, you get that improvement. And the first 10 orders coming to the live trading room with me, we're up over $800 so far this week in 2 trading sessions. I trade the session live with Chart Trader up. We do a detailed assessment of every trade, and that's $800 real dollars. Our goal every month, every week, is to make at least $1,000 after commissions. Now we're looking at a $1,500 to $2,000 week. Always trading in the direction of the multi-time frame assessment of momentum. Now let me really quickly answer as many as I have, and I'm really hitting 2:15. Let me go 60 more seconds and go to questions. Hang on one sec. Okay, let me just keep scrolling. Keep scrolling. Hang on. These are questions from before I started. Okay, here we go. Yeah, I mean, John, it's supply and demand is exactly what we're looking for. That's correct. And let me keep moving. Okay, here we go. Okay, Aaron says you're right. I had instances where I traded the divergence. Aaron, you cannot trade divergence. If you trade in the direction of the Laguerre and trade in the direction of of momentum, when it's locked long on three time frames aligned, that's where you're going to get your winners. We're plotting a Unorenko. It doesn't matter the kind of bar you use. G. You can use a time, a tick, a range. Does not matter. We trade Unorenko in the trading room because I really like it, but this does not make any difference. Lou, I'm trading a 2 Unorenko or a 4 Unorenko. You could Dr. Keith trades a 5-minute, a 15-minute, and a 45-minute. Now Thinkorswim has an API, Lou, and we can run NinjaTrader from your Thinkorswim and run NinjaTrader forever for free. Now you're going to have to take the signals off of Ninja, but you get to run Ninja on a demo forever without any increase in price. So we don't have it on Thinkorswim, but Thinkorswim runs NinjaTrader. We have a lot of traders doing that. That's how we do it for Thinkorswim, Ken. And I always get that question about TOS. 2 contracts, Liam. We trade very small amounts in the trading room. I could trade 10 contracts or 20 contracts. I don't want to do that. What I trade in the room is what I want everybody in the room to have the capital to trade. So we trade 2 on crude and 3 on the NASDAQ, because that requires, a very small amount of capital and very little margin. And we have many traders who just take the NASDAQ trades. Liam, this indicator is new. Last year, 58,000, but we didn't have this indicator. So I expect that we're going to do better than that. This month, we're going at a great clip. And this week, we should, unless, lightning strikes, we should have a $1,500 week on a very small number of contracts. And that is trading the right edge live. Yes, we are, Brad. You can swing trade this, Liam, because this is independent of time. You can trade 2-hour bars, 4-hour bars. We have trades. Remember I showed you trades on the Qs that were 30 minutes, 60 minutes, and daily? Makes no difference at all. We connected 2 for you, Lou. Last thing I'm going to say is that we do the entire configuration for you. If you're on Thinkorswim, we do it. If you're on NinjaTrader, we do it. We have a tech guru here, Sergio. He's got a master's degree in computer science. He's brilliant, and he'll do the entire configuration for you. So listen, thank you so much for listening. Really appreciate it. Listen, it's going to help you trade because you must trade this multi-time frame assessment leads price. I mean, it's telling you where price is going to go, and if you trade against it, you're going to have trouble. Okay, gotcha, Liam. All right, everyone, listen, I've got to turn it over. My pleasure, Aaron. I thank Traders Corner for having me, and I really appreciate all of you for giving me your time. Hey, thank you, Aaron. Thank you, guys and ladies. Best of luck to all of you. Bye-bye.